Well, hello everyone. In this particular lecture, we're going to go through the homework here for Chapter 6. Chapter 6 is dealing with general government debt and specifically the debt service fund as well. So the first homework problem we're going to go through is really just kind of a buffet line of different types of journal entries we would get into if we were dealing with debt. So let's take a look at number 1. The general fund collected and transferred $750,000 in tax collections to the debt service fund. Of that amount, $600,000 of the amount was used to retire principal amounts of the bonds, and the remainder was used to pay interest. All right, so basically what we have here is we've got, first of all, the general fund is collecting tax money, so debit cash, credit revenue. Now, if we go all the way down to 1E, the corresponding journal entry in the government-wide is debit cash and credit. And remember, all taxes are general revenues. Now that money comes in, $750,000 into the general fund, and the general fund turns around and quickly transfers it to the debt service fund. That would be recorded as a debit to other financing uses and a credit to cash. All right, this is something that on the debt service fund, they're on the opposite side of that, and that would be a debit to cash and a credit to other financing sources. Because the transfer out and the transfer in between these two governmental funds that net each other out to zero, we are going to not have any corresponding journal entry on the government-wide statements. And last but not least, while the debt service fund has the $750,000 in cash, they turn around and they spend it right away. $600,000 on principal and $150,000 on interest. They are both expenditures for modified accrual accounting. The corresponding entry on the government-wide statements, the interest piece is an expense, but the payment of principal would be a liability, a debit to the liability account. So that is the difference between modified accrual and accrual accounting. Okay, next, number 2. A $5 million issue of bonds to finance a capital project was sold at 102 plus accrued interest of $50,000. The accrued interest and premium were recorded in the debt service fund, and that is quite common. Remember, the capital projects fund, they usually get the principal amount. And so we see that here, debit cash and credit other financing sources for the $5 million. Now the additional monies, the 2% premium, that's $100,000. That is going to go to the debt service fund as a credit to other financing sources. And the $50,000 interest that we pre-collected from our bond investors, we're going to give it back to them, of course. But we have to credit revenues for that $50,000, and the debit goes to cash. While these two governmental funds are recording these journal entries, the government-wide journal entry using accrual accounting should be very simple for you since you've learned it in your theory classes. We will debit cash for the full $5,150,000. $5 million of that is the bond payable, 2% premium. Credit premium on bonds payable, and the $50,000 would be interest payable that's going to go back to the bondholders at the first interest payment. All right, number 3, the debt service fund made a $110,000 lease payment. $15,809 of it was interest, and the rest went to principal. Funds used to make the lease payment came from a capital grant received by the Special Revenue Fund. So first, in the Special Revenue Fund, debit cash, credit revenues. And while that's being recorded in the Special Revenue Fund, in the government-wide statements, Journal Entry 3E, debit cash, and most grants, if they have a specific use, is going to be recorded as a program revenue. Now that money is immediately transferred to the debt service fund, so the Special Revenue Fund would debit other financing uses, credit cash, and on the debt service fund side, debit cash, credit other financing sources. That $110,000 is then immediately spent. Principal and interest in the debt service fund are both expenditures, This is the way modified accrual works. Remember, there is no long-term liabilities here. It's all expenditures. However, on the government-wide statements 3F, the expense goes to the interest is expense, but the principal payment goes to a debit to the liability. That is the difference between the accrual and the modified accrual. Number 4, tax-supported bonds, 3.5 million par value, were issued in cash to permit refunding of a 3.5 par value. So new bonds are issued to pay off old bonds. This is a refunding. And the interesting thing here that we learned in this chapter is when new bond money comes in, debit cash, credit other financing sources. And this is what you need to understand. When the old bonds are paid off with refunding money, the debit is going to go to other financing uses. Now, in this chapter and in earlier chapters, whenever we paid back principal of a debt, we debited an expenditure account. We don't do that with refundings. We debit other financing uses up to the amount of the new bond money that came in. Now, if there were any other old bonds that were paid off after the new bond money came in, then we would debit expenditures. But in this case, the ceiling of 3.5 million would be debited to other financing uses. Now, while that's going on in the government-wide statements using accrual accounting, the new bond money come in by debiting cash and crediting bond payable, and the old bond is being paid off, debit bond payable, credit cash. So the accrual accounting is pretty simple when you think about it. Skip 5. Let's take a look at number 6. A $5 million issue of construction bonds were sold at par. So no premium, no discount. They were sold at par. And we had some debt issuance costs of $45,000 and prepaid insurance of $5,000. So in the Capital Projects Fund, we're going to receive the $5 million bond by debiting cash, crediting other financing sources. While 6A is being recorded in the Capital Projects Fund, 6C is reported in the government-wide, debit cash, credit bonds payable. So clearly difference in the accrual and modified accrual. And next, paying for the $50,000, $45,000 is administrative costs and $5,000 in prepaid insurance. Well, in the Capital Projects Fund, they're all expenditures. Debit the expenditures, credit cash. However, on the government-wide statements using accrual accounting, the $45,000 is an expense, but the $5,000 is an asset called prepaid insurance. So there are major differences between modified accrual and accrual. All right, so that's kind of a buffet item there. Let's take a look at a couple of longer problems here. So this first one, we have the city of Amarillo. They issue 8 million 3% serial bonds to construct a new exit off the highway. The bonds mature in equal annual amounts beginning on January 1, 2021 for 10 years. And they pay interest every January 1 and July 1. All right. Oh yeah, the city is required to use all accrued interest and premiums to service the debt. Okay, so let's go through some of these journal entries. Number 1, or Part A, prepare the budget for 2020, assuming the bonds were scheduled to be issued on January 2nd. That's important because when are the interest payments supposed to be made? And I'm highlighting it here. They're supposed to be paid every January 1 and July 1. So if the bonds are issued on January 2nd, how many interest payments would we make in the first year? Well, only one, the July 1st. And so one interest payment is 6 months. So 8 million times 3% times a half a year, that's $120,000. That is the only budgeted expenditure for the year. So we're going to credit appropriations, the budget for the expenditure, for $120,000. Now it went on to say the funds to pay interest will be transferred from the general fund. So we are going to also budget for an estimated transfer, estimated other financing source. That's the only budget that we need to make for the year. Now, remember we were planning on issuing bonds on January 2nd at par, but we didn't. We missed both marks. We didn't issue them at par. We issued them at 101, so we issued them at a 1% premium. In addition to that, did we issue them on January 1? We did not. We wound up issuing them at February 1st. So two things happened here. We need to first we need to record the fact that we got the $8 million in the Capital Projects Fund, debit cash, credit other financing sources for the $8 million. In addition to that journal entry, we need to record the 1% premium surprise. We weren't expecting that. So 1% of $8 million is $80,000, and that is going to be credited to other financing sources in the debt service fund. Remember, the Capital Projects Fund doesn't need this money. And also, we sold it 1 month after the interest payment date. Remember, the interest payment date is January 1. So we've collected 1 month's worth of interest. And if we do 8 million times 3% times 1 month, or 1/12, we get $20,000. That is going to be recorded as a revenue on the debt service fund, but on the government-wide, using accrual accounting, we will debit the interest payable. And then lastly, remember we said that all interest will be serviced by transfers from the general fund. So to pay this $20,000, the debt service fund is going to receive that transfer from the debt service fund, debit cash and credit other financing sources. All right, and here is the July 1st interest payment. Remember, 6 months worth of interest, $8 million times 3% for half a year. That is $120,000 on the debt service fund, debit interest expenditure, credit cash. But on the government-wide, which uses accrual accounting, a little bit more intensive. Remember, as we learned in your theory classes, first, we need to, that interest payable that we recorded when we collected it up front. Oh, where is it? Here it is. We collected up front from our bondholders. We got to pay them back that $20,000 interest payable. We also need to amortize the premium. Remember, this is a 10-year bond, pays interest twice a year, so there are 20 interest payment dates. What we're going to do is we're going to take this $80,000 premium, divide it by 20, because there's 20 interest payment dates. That is straight line amortization of $4,000 per interest payment. So I will amortize the premium with a debit of $4,000, and the remainder gets debited to interest expense. So in this case, you can see the accrual accounting is a lot more intensive than the modified accrual accounting. Okay, and now let's go through one more problem. This is a very long problem, although pretty straightforward in my mind. But we need to just follow the numbers, and these are very typical journal entries that we would see in a debt service fund, as well as a capital projects fund. The good thing about this homework problem is it really takes the capital projects fund and debt service fund and shows how closely related they are. They really do indeed work hand by hand, side by side. All right, so we have the town of Mountain View. The residents authorized a $5 million renovation to their historic town hall. And so where's the $5 million going to come from? Well, $2.5 million is going to come from a 5% bond. $1.5 million is going to come from a state grant. And the other $1 million is going to come from a transfer from the general fund. Debt service for the bonds will be provided by a 1/4 cent city sales tax. All right, that's where we're going to get the money to pay back these bondholders. All right, so first thing we need to do is record the budget for the first year. And in the first year, sales taxes of $350 are expected to be collected. That is going to be my debit to my estimated revenues. The only appropriation, remember the appropriation is just a fancy word for budget for expenditures. The only appropriation is expected to be 6 months of interest. Well, if we do the math, what do we have? We have a $2.5 million bond times 5% for a half a year. There is your $62,500. The difference to balance the journal entry, whatever is needed, debit or credit, is recorded to the budgetary fund balance. There's no journal entries required in the capital projects fund, or in this case, the government-wide. There's no budgeting in the government-wide statements. All right, B, our friends, the general fund, they transferred $1 million to us. So that money is going to the capital projects fund. Nothing in the debt service fund, but the capital projects fund, debit cash, credit other financing sources. Now, I know the author didn't show it here, but in the general fund, we had debit other financing uses, credit cash. And because that transfer was between two governmental funds, it really nets to zero. That is the reason why there's no journal entry in the government-wide. All right, now our beginning expenses, our planning fees, our architect fees, $200,000. That is going to be an expenditure in the capital projects fund, debit the expenditure, credit cash. But in the government-wide, it's going to be capitalized as part of the asset, the WIP, credit cash. Nothing going on in the debt service fund. D, the town hall construction contract is awarded to a contractor. All we did was sign a contract, and that would be recorded as an encumbrance in the capital projects fund. Debit encumbrances, credit encumbrances outstanding. That encumbrance accounting is only for the governmental fund, and that is why we don't see anything in the government-wide statements. All right, E, on April 1, 2020, the bonds were issued. Face value is $2.5 million. They have maturities ranging from 1 to 20 years at 102. That means we sold them at a 2% premium. Bonds bear interest, as we saw earlier, at a 5% interest rate, payable semi-annually on April 1 and October 1. So we actually issued the bonds on the interest payment date. So we don't need to worry about collecting excess interest from our bondholders just to turn around and pay it back to them. All we need to know is we received $2.5 million. Okay? That money is going to go into the debt service fund. I'm sorry, the capital projects fund. They're going to get the $2.5 million because remember, the monies are for the construction. So capital projects fund, journal entry E3, debit cash, credit other financing sources. Now, the 2% premium, 2% of $2.5 million is $50,000. That is going to be diverted into the debt service fund. Debit cash, credit other financing sources. Now, this is surprise found money. We weren't expecting this. We didn't budget for it. And so what usually happens is the debt service fund, when they receive this surprise money, they're going to go ahead and update the budget as well. And we will do so by debiting estimated other financing sources and crediting the budgetary fund balance. We weren't expecting that. It just came in. And all while the two governmental funds are recording these journal entries, we can see in the government-wide statements E4, the cash of $2,550,000. $50,000 of it is the premium, and $2.5 million is the bonds payable. All right, the capital projects fund paid the utility fund for wiring. All right, so no encumbrance was recorded for this. This is something that we just paid another proprietary fund, the utility fund. It's an enterprise fund. So capital projects fund, it's an expenditure, debit expenditure, credit cash. However, on the government-wide, using accrual accounting, that's going to be capitalized as part of the WIP account, credit cash. On October 1, the first semi-annual interest payments are made. And once again, that would be $2.5 million times 5% for half a year. That is $62,500. Debit interest expenditure, credit cash for the debt service fund. However, on the government-wide statements, remember that we had a premium, and that premium, if you recall, was $50,000, and that $50,000 is to be paid or to be amortized over 20 interest payment dates. If you take $50,000 divided by 20, you are going to get $1,250. That is the amortization of the premium, and the difference is going to go to interest expense. Letter H, sales tax was collected. And remember, the sales tax, this is the 1/4 cent sales tax. That was revenue to be earmarked for the debt service fund for payback, eventual payback of the bonds. So that money is going to go into the debt service fund, debit, cash, credit, revenue. In the government-wide statements, remember, our taxes are general revenues. Okay, our contractor gave us a progress billing of $2.5 million. So in the capital projects fund, two-step process. First, we're going to reverse the encumbrance by debiting encumbrance outstanding and crediting encumbrance, and we will immediately replace it with the actual expenditure. And in this case, it's the same amount. Debit the expenditure, credit the payable. While that journal entry is recorded in the fund, in the government-wide statements, that money gets capitalized. We're just building our WIP account. Debit WIP, credit the payable. Okay, the $2.5 million bill is paid, except for a 5% withheld for retainage. So in the capital projects fund, we're going to get rid of the liability of $2.5 million. 95%, or $2,375,000, we're going to pay, so we'll credit cash, and the amount withheld, in this case $125,000, we're going to put in another liability account called contracts payable dash retainage, or retained percentage. Same exact journal entry on the government-wide statements. Letter K, the grant of $1.5 million came in, and that is going directly to the capital projects fund. Debit cash, credit revenues, same journal entry on the government-wide. We just need to be a little bit more careful. Grant monies, as long as they have a specific purpose, are going to be recorded as program revenues. And here we are at the end of year one. So at the end of year one, we're going to close our entry. We're going to close all of our budget accounts as well as our operating accounts, our actual operating accounts. So in the debt service fund, we're going to close our appropriations with a debit. We're going to close our estimated revenues and sources with credits. And that will get closed out to budgetary fund balance, in this case a debit. And we're going to close our actual accounts. Close our revenue and our sources with debits. Close our expenditure with credits. Everything is getting closed out to restricted fund balance for the debt service fund. Remember, all the monies we received into the debt service fund were specifically from basically a third party, in this case the taxpayers, agreeing that the sales tax is going to be paid specifically for this reason. All right, and the capital projects fund, we will close our revenues and our sources with debits, close our expenditures with our credit, but we need to be very careful. Our fund balance is broken down between restricted and assigned. Remember, the $1 million we received as a transfer from the general fund, that's assigned. That's basically the government's management dictating on how that money to be spent. All the other monies that were received from third parties, those are restricted. All right, so that was year one. Now let's take a look at year two. First thing we got to do in year two is record the new budget. And in the new budget, what we have to keep into consideration is we're expecting $300,000 in sales taxes. We are also expecting to make 3 payments during the second year. And those 3 payments are as follows. We're expected to make a principal payment of $250,000 on April 1st. We're also expected to make an interest payment on April 1st, as well as October 1st. That totals $368,750. Let me give you the breakdown of the $368,750. If you are taking note, this would be important to write down. All right, so that $368,750 is made up of three pieces. Piece number one, $250,000 principal payment. That's piece number one. Piece number two, the interest payment on April 1st. Well, the interest payment on April 1st is as follows. $2.5 million times 5% for a half a year. That's $62,500. Now, the third piece is the interest payment on October 1st. And that would be principal of $2,250,000. Remember, we paid $250,000 earlier. So the bond is no longer $2.5 million, but $2,250,000 times 5% times a half a year. That works out to $56,250. Well, if you added up those three numbers, you'll get the $368,750. All right, so that's the budget. Budget is only for the fund, not for the government-wide. All right, now we collect sales taxes of $250. So the debt service fund, debit cash, credit revenue. Similar journal entry on the government-wide. We just need to denote that our taxes are general revenues. Letter O, we got a new progress billing from our contractor, $2.2 million. We did an inspection and we discovered a leak in the roof. So all we need to do is in the capital projects fund, we need to reverse the encumbrance, debit encumbrances, outstanding, credit encumbrances, and immediately place it with the expenditure. Debit the expenditure, credit the payable. While that's being recorded in the fund, in the government-wide statements, we're capitalizing those amounts in the asset account. Debit the WIP, credit the payable. We can't close it out and pay them back their retainage because we have this leak that needs to be taken care of first. Letter P, public work employees installed a new sidewalk and landscaping, $130,000. So the capital projects fund will debit an expenditure, credit cash, but the government-wide we will capitalize that. Debit WIP, credit cash. Now the roof leak was repaired. All right, good job. So in the capital projects fund, because the roof leak was repaired, we can now pay our vendor their $2 million last invoice plus the retainage. If you recall, the retainage from a prior year, we held back $125,000. So we're going to pay all of it. We'll credit cash for the full $2,125,000. The government-wide is the same. All right, R. The April 1st payments are made. Now remember, on April 1st, we have to pay back principal plus interest. And if you recall from my calculation a few moments ago, we're paying back the $250 principal. That will be an expenditure for the debt service fund, as well as 6 months worth of interest. $2.5 million times 5% for half a year. That is what that $62,500 is. Now in the government-wide, once again, we have to amortize our premium. It's the same, $1,250. That is the $50,000 divided by 20 periods, I believe it is. Actually, it's 40 periods. It's 20 years, 2 times a year. 50,000 divided by 40, that's a 1,250. The difference is the expense. And of course, the $250,000 principal payment, we will debit the liability bonds payable. The renovation is complete. So after all is said and done, there's $120,000 left over after the construction. So the capital projects fund is going to transfer the $120,000 out to the debt service fund. So journal entry S4 in the capital projects fund, debit other financing uses, credit cash, and the debt service fund S1, debit cash, credit other financing sources. All right. And that money we weren't expecting. So the debt service fund, once we receive this $120,000 newfound money, we will properly budget for it. So journal entry S2 is a budget amendment. We will debit estimated other financing sources, credit budgetary fund balance. All right, now in the capital projects fund, because the project is complete, we will close out our expenditure account with a credit. We're going to close them out to our fund balance accounts. Remember, our assigned fund balance was $1 million, but $120,000 came in unexpectedly, so we're going to close out only $880,000 to assigned fund balance, and the remainder to restricted. And S5 is to close out that other financing use account. After we transferred it out, we'll close it out with a credit, and the debit goes to fund balance. While the projects fund, the capital project and the debt service fund are doing all that, in the government-wide, the accrual accounting looks very simple. The building is done. The process is done. So we will debit buildings for $4,750,000, and the $130,000 was the land improvements and the landscaping and the like. We will debit that, and we will get rid of the WIP account with a credit. Very long journal entry, very long problem, but it is really good because it shows you how intertwined the capital projects fund is with the debt service fund.